Hey guys, Chills and Day here with ChronoStory.com. Today we're going to be talking about how to predict stock market crashes. Uh, the short summary of this article is that there are three variables that lead to stock market crashes. That is going to be innovation, credit, and consumption. This type of article is important to you because if you understand how these variables impact stock market crashes, you can pull an investment out, or if you're a savvy investor, you know how to short or buy an inverse ETF, or run credit spreads or something. You can actually make a lot of money from this. There are a couple people who've actually made billions of dollars from flash crashes over the past years. So anyways, we're going to jump right into this. I'm going to try to make this as fast as possible, but be aware that at the end of this, the point of this article is to present a methodology for you that you can use in your own portfolio. So as such, it's more academic in nature, but I'm going to summarize it as quickly and fastly as possible. So to give you a quick itinerary of what we're going to go over, first we're going to touch on uh, the difference between Malthusian economies and industrial economies. Next, we're going to touch on what drives industrial economies. Third, we're going to touch upon previous stock market crashes and how the industrial economy failed, and how those three variables failed within those economy situations. Four, we're going to touch on how computer algorithms impact current economies. And then five, we're going to present the methodology. So we're going to make this as fast as possible and as succinct as possible. That way, we can all get back to our lives. So, anyways, let's jump right into this. So, basically, in order to accurately predict the stock market crash, you understand how the U.S. economy leads the global economy. The U.S. economy is faltering, and what variables to look for to predict the crash. The reason why the U.S. economy leads the world's economy is because it's the largest consumption. Currently, it's the largest consuming economy in the world, which means if you're in Europe and you build a product, you want it to enter the United States because you have a higher likelihood of people just buying millions of dollars worth of it just because they simply have the excess cash to do it. You don't really hear people entering into African markets because there isn't much of a consuming, you know, economy. This is one of the major reasons that Great Britain had to leave India because India, they gave up the crown jewel. The crown is what they called it, because the underlying Indian economy just decided, hey, we're not going to buy British goods anymore. There's no consuming audience. The industrial economy failed in Britain. So we're going to look into how you can make money from this type of stuff. So what we're going to be touching on, we have to touch on the algorithms, that advanced computer trading algorithms that are, auto price risk essentially, and then I'm going to give you the methodology to predict the stock markets. So here at Chrono History, I teach people how to generate above average market returns. This is called alpha within the industry. Um, I do this so that everyone has an equal shot at making money in the market. A lot of people are fed false information, such as they can look at charts, for example, and if they see like a certain pattern evolving and the stock's going to do this, yes, charting does have some sort of validity. And you can look at the CMT if you want to have further explanations of that. But what it really comes down to is there's a whole world, literally a whole world out there that the average retail investor is not aware of, that they can use tools in their toolbox, methodologies, and investment vehicles to retire early. They don't have to work till they're 60 or 70 years old. They can work for 10, 15 years, and if they just employ the methodologies the pros are using, then make a lot of money. And this scares a lot of people in the street. I mean, why would I invest with a hedge fund to give them a 2 and 20% if I can just do it myself? So that's what Chrono Historia here is about. We have a free newsletter. Feel free to sign up if you want to remain up on top of it. I do not use that to push anything. I just use it to keep you guys updated on the type of articles that are coming out and evolving trends. So without wasting any time, let's jump right into the article on how to predict stock market crashes. So first thing to touch on is how the stock market works, right? Uh, Really simple. The stock market runs off of allowing investors to efficiently move capital from bad investments to good investments. If you succeed in doing this faster than your other investors, you will be rewarded with excess capital. You'll be rewarded with revenue, ROI, return on investment, whatever you want to call it. And this is called the efficient market hypothesis theory. Uh, the theory that markets are incredibly efficient at allocating capital, and everything will be properly allocated over time. What that means is if no innovation ever happened, no one made any new products, no new businesses, eventually the market would return to zero as all capital is efficiently allocated. This would take time, and if you are a faster moving investor than your friends, you would pull capital out of the market sponge, so to speak. Uh, so that's how stock markets work. Right now, we're going to touch on how Malthusian and industrial economies are different. This is very important. So, market risk and industrial economy versus Malthusian economy. All right. To briefly explain this, before the Industrial Revolution, we lived in a world where agrarian economies ruled. This is called the Malthusian economy. Population and land is what created GDP. Both of those are finite. What that means is there's only so much land to go around. If you're a king and you're in Great Britain or something like that, and you own, I don't know, 20,000 hectares of land, you own like England, right? You only have so much land that can be farmed, right? Farming land will thus produce goods which can feed a population. You have a capped out population. This is why people would go to war for more land. This led to something called the Malthusian trap. This was Sir Thomas Malthus was an English cleric that lived in the 18th century, so he wrote about this during the Industrial Revolution. Now, what happened was the Malthusian trap is that populations will cap out, land will cap out, and thus GDP will cap out. Eventually, there will be no reason to open a business. There won't be any excess money left over. Fortunately for us, in 1790, 1795, we had something called the Industrial Revolution take place. The Industrial Revolution was for the first time when businesses started breaking off from the agrarian style, breaking off from landholding elites, and creating their own little tiny economies for which they would import on one end resources and human capital, and the business model would, combine that all together and spit out a product and generate excess resources. What this meant is that for the first time, intelligence, research, preparation, planning, capital drove economies, not land and people. So as we can see in this graph right here, the Malthusian economies do grow over time, but it's very, very slow, right? With the industrial economy, it's parabolic. People innovate. Capitalism reigns supreme. Faster, faster, faster. Think of like Tesla. No one was talking about electric cars 15 years ago, and now all of a sudden everyone has an electric car. The entire EV industry changed the world's market. Stuff like that. That would never happen in a Malthusian economy. That's just stock markets wouldn't. They exist in the Malthusian economies, but they were like for moving, bushels of corn, and it wasn't about investing in actual companies. But that's a story for a different day. So just be aware the total risk in an industrial economy is that, let's say, businesses fail or consumption stops, is 100%. In theory, the market can retrace all the way back down to the Malthusian standard for where, we have kind of, for people who understand, it's the kind of the book value of the economy, if you want to use like, valuation terms, how much the economy can retrace back down to its median level. So the industrial economy has maximum amount of risk, but also maximum amount of reward, much, much higher than Malthusian. So why does this matter to predicting stock market risks, right? Well, the industrial economy, there are certain things that can go wrong that'll cause the entire machinery, everything, the economy from grinding to a halt. When that happens, the stock market crashes. It crashes back down to the Malthusian level or near it. If we ever had a stock market crash went back to Malthusian level, it's like Mad Max style, but retracings happen. So let's look at how that happens. So the reason why stock markets can grow and stock market crashes can happen is because of the industrial economy. When the industrial economy fails, we have a stock market crash. Plain and simple. That's what drives it. So what drives the industrial economy are these three concepts. It's very important everyone understands. It's innovation in the form of businesses. It is credit in the form of loaners, people who think, hey, your business model is pretty good, I'm going to give you money. Or credit in the form of, hey, you want to buy this shirt or t-shirt, I'll give you money. You're going to give me something back in return. And then consumption. If you have nobody buying the product, there's no reason to have innovation, nor is there a reason to have credit. If all three of those variables are not working in equal parts, you will have a stock market crash. There's just no way around it. So I have some articles here that are academic in nature, and they go over this. I recommend you guys check it out if you have the time. They're pretty cool. I thought they were cool at least. But the reason why I'm doing this video is because you guys don't have to spend 10, 15 minutes reading this. I could just give you a quick presentation. So we're gonna look at stock market crashes of the past and explain how these three variables impacted them. There's really only three major stock market crashes over the past 100 years. Obviously, the first one was the events of 1921 that led to the Great Depression. The next was the 2008 recession, and finally, third, we're living through the midst of it, 2020 pandemic. Now, in all three of these situations, the industrial economy failed. I'm just going to cut straight to that chase. I'm going to show you how. So let's get right into that. Stock market crash of 1929. Basically, for those who don't know, the 1920s was called the Roaring Twenties because for the first time in the history of the United States, Americans had access to capital. They had access to credit. People could go out and start emulating the rich and famous. Think like Great Gatsby, if you ever seen the movie or the book's pretty good. people were emulating. They were going out on a loan. Saying such as "buy now, pay later" became synonymous with the 1920s. You wanted to buy that flapper dress, you didn't have the money. Don't worry about it. You can pay it back whenever you do get the money. Now you just keep kicking the can down the road, and your entire life is made up of loan and debt. Okay, cool. Well, what happens? Well, hopefully the banks are keeping tabs on this, right? Well, eventually, the buck stops here, and all these loans, just much like margin, get repaid. And when you have a population that is no longer consuming the credit nor the loans, there's no reason to have innovation. Without innovation, there's no credit. Credit comes collapsing, the market comes grinding to a halt, the industrial economy has failed. So that's the stock market crash in 1929. In reality, one of these variables just has to get out of whack, so much so that it jeopardizes the other two, and then you have a crash. So in the 1929 crash, it was kind of a crash because of innovation. Innovation on the form of new credit loans, new ways to new financial products, new goods, new services, new businesses. The steel industry was booming at the time. Innovation was going so fast, but yet consumption came to a grinding halt when all the credit was called back. So the economy was growing too fast for something good, to summarize. And if you look at a stock chart, you can see that. I think from like 1920, the end of World War One, up to 1928, it was like parabolic, much like we see today, which is kind of scary, but that's a different point. The situations aren't the same, by the way. It's a eerie coincidence. Yeah. So the 2008 stock market crash. This one really grinds my gears and bubbles my cauldron, so to speak, because it was completely avoidable. Uh, in the mid 90s, it really started with the Clinton administration, but there was this push to get everybody into a home in the United States. There was the Taxpayer Relief Act in 1997. There were some other things. Um, and what this basically meant was like, oh, hey, you want a home? We'll give it to you, right? You'll get, low financing options, XXXX. Well, this all sounds good in paper, but when you have 300, 200 million people all applying for homes, there's a huge credit issue. The majority of them will probably default on it because they can't pay for the home payment. And the financial institution knew this. They absolutely knew this. And so what did they do? They repealed the Glass-Steagall Act. What that meant is that let's say you have 100 people with home loans and 80 of them can't pay it. Well, hey, don't worry about it. We're just going to bundle all 100 of them together, and the 20 that can pay will make up the difference. All right. Well, the issue is if all 80 of them default at the same time, it's a snowball effect where the bank defaults. And if the bank defaults, they come for everybody's property because somebody has to, recoup the losses. And a lot of people don't want to admit this, but if you have a mortgage on your home, you don't technically own your home. The bank does. So if the bank defaults, the person who owns your home defaults, whoever's holding the credit for that bank can thus come claim your home. And then we have the housing crisis in 2008. It was completely avoidable. That's the sad thing about it. But it was greed on the part of the credit, greed on the form of the creditors. Which is why, if we go back to the three variables that impact stock market crashes, it was credit this time, right? Credit got out of control. If all right, so you're an 18-year-old kid who's making like $6 an hour. Congratulations, you can get a house for 700,000. And the movie, I think, The Long Short, did a great way of explaining this, and I suggest you guys all go check it out. And if you're not upset by the end of that movie, then you just haven't seen it, right? Uh, it was greed on the form of several banking firms, mortgage lenders. Basically, everybody was bundling these subprime loans together and kicking the can down the street. And every single bank was speculating, oh, hey, we think this bundle of loans will, perform better than this bundle, so we'll buy it and then we'll resell it. Well, all that speculation means nothing if the underlying loans fail, right? The underlying subprime loans collapse, and you have those Glass-Steagall bubbles that explode, and thus we have the housing crisis. So credit is really the main one to blame here. It wasn't so much innovation, unless you call it innovation in financial products, but I wouldn't even call it that. It was really a failure of policymakers to kind of rein in the financial institutions that govern Wall Street. Uh, and so because of that, if you had this credit loan fail, which thus led to a consumption failure, because if nobody has any money because all their homes have been foreclosed, no one's going to go out and buy goods. If no one can buy goods, there's no reason for businesses to innovate. No innovation, they don't go out, they don't take out more credit loans. No money is moving. The industrial economy has failed. So then we have a retracing, right? I don't know how much I think it dropped like 35, 40% over like a couple months or so. which is really really far. I mean, everyone's 401k is destroyed, and their house value has been destroyed. But if you knew what you were looking for, you paid attention. Everyone thinks this happened to nowhere. A lot of economists were sitting there, and they were saying like, "Hey, this is going to happen." I think if you go on the Wikipedia page for the 2008 crisis, there's like a list of like 200 people who were like on TV, like in 2005, like 3 years before the events, like, "Hey, uh, this is this event's happening, and we need to do something about it now." But the issue is just nobody wanted to believe it. Everyone wanted to keep buying their houses. It was runaway credit effect. Anyways, yes. Oh, this is pretty cool. Inflation-adjusted U.S. home prices, population, building costs, and bond yields. As we can see, from 1920 to 1980, 1990, it kind of was like stable. Uh, and then in like the early 2000s, with the repeal of the Glass-Steagall Act, you just mortgage lenders were just like, hey, just give everyone a house, and it shot up through. So the reason why is because, like I said earlier, when all the credit got called back, consumption stopped. When consumption stopped, innovation stopped. When innovation stopped, credit for business loans stopped. The industrial economy had failed. So now we get into the 2020 pandemic and stock market crash. So, plainly speaking, it's a bit too early to talk about this. I mean, this video is coming out in 2021. I'm sure like people 5, 6 years from now will be like, "Oh, hey, he forgot to mention this effect." And sure, you're probably right. But as it stands right now, it's still pretty early on in the after effects of the pandemic. But we can talk a little bit about it. Basically, this one's pretty easy. With the pandemic, consumption came to a halt, right? With everyone being quarantined, people weren't going out buying goods except for grocery, or whatever. Uh, there's a study here that goes over the reflections in the S&P 500 of people rebalancing portfolios. The world is becoming more isolationist. This is being reflected in policy changes. Basically, what ended up happening was no one was buying goods. There's no reason for businesses to make new goods. If businesses aren't making new goods, there's no reason for them to go out and let me get a line of credit. No line of credit, no consumption, no innovation. Stock market fails. Uh, but yeah, I'm really interested to see what type of academic articles are going to come out on this front regarding this. I read a couple, probably about I say about 2 or 3 times a week. I delve into academia.edu to figure out what people are talking about, and there's always some interesting ones that are coming out. But still, it's way too early to tell. But yeah, oh, here's the source on credit default rates across Europe during the pandemic. That was pretty cool. That's a good read for people who like math. Anyways, so now let's fast forward. Let's talk about how risk models are automatically adjusted and priced in the current stock market. So, for those who haven't seen my previous video on how stock trading was done before computers, you can go check that one out after this. It'll help you out. But pretty much before I'd say 1975, 1976, everything was done by hand. 1963 is when computers came on the Nasdaq. They were just like very, very primitive. Uh, what I mean by hand is you had stock tickers come out to a firm's desk, and you have people who legitimately were paid to sit there and be like, all right, at 9:30, GameStop is worth $15. At 9:45, it's worth this. And they would chart it out on a graph, and then you'd have a fleet of analysts that would be going over the recent financial reports, and then they'd go to management of the firm and they'd be like, hey, we think GameStop in the next 5 days is going to go here, uh, and then they would invest off that, right? Now, all of this, computers revolutionized the game, right? The time it took for you to make a trade before computers would have been like 3 or 4 hours at the fastest, and that's you going fast. Before telephones too, so this is like 19th century. When telephones came out, it sped up a bit, but not much. Computers really are what impacted everything. So when computers came out, we had algorithms that come out, automatic pricing, automatic risk adjustment based off of whatever variables a fund wants to use. So we're going to talk about 2 crashes. All right, and it's very important we remember how fast these crashes happen. First one's 1988, and the second one's 2010. The flash crash from 1988 lasted about 3 hours, and I think no one really knows what it was caused by, but a lot of experts kind of agree it was caused by primitive algorithms and hedge funds buying and selling the spread and causing an order imbalance at the open on October 16th, as you see here in 1988, which has caused the stock market to plummet. I think within one day, the world's market lost between 20 and 50%. And this is because people just didn't understand how fast algorithms could buy and sell into each other to cause a flash crash. And when all was said and done, the world was like, whoa, whoa, what just happened? Why are we all poor now? Well, the answer is because a couple hedge funds built algorithms using the same methodologies that they share amongst each other that look for the same flags, so to speak, same variables in whatever data set they're looking at, and automatically sell and liquidate their positions. This happens all the time. The most recent effect, I would say, would be the crash in 2021 due to GameStop. GameStop was rising so fast it was causing massive volatility, and everyone was liquidating their positions, including the automatic algorithms. So if you guys want to do a quick little look, you can look at SPY. The value of SPY in late January actually went down, which usually doesn't happen in January. But if you look at GameStop, it coincided with the rise in GameStop, and that's because algorithms are automatically pricing in movements and selling and liquidating positions. But anyways, back to the flash crash in 1988. This was like the first major time algorithms messed with the market. And that's why it's so interesting, because a lot of regulations came out regarding this, and it still hasn't gotten it perfect because you can't really prevent people from trading their own stocks. You can shut down the brokerage firms, but people can still go find their own markets, so to speak. So for hedge funds, you can't really stop it. So yeah, it's important to understand that this took 3 hours to crash the world's market by between 20 and 50% due to algorithm selling. Now let's talk about the flash crash in 2010. Algorithms are faster now. There's more variables. So instead of taking 3 hours to crash the market, it only took about 36 minutes. This was 2010, and the U.S. market lost over $1 trillion in valuation in 36 minutes. Wow, right? That'd be the equivalent of the SPY losing like 6-7%, like at market open, for no reason. It's just huge, and that's because this one's actually pretty funny. But all this was caused by one single trader who wanted to emulate how hedge funds use high frequency trading and made his own algorithm. And he imported it, but it turns out the algorithm he made was using the variables that were red flags for the fund's variables. So as he was trading, all the funds were like, whoa, 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 something crazy is going to happen, and they liquidated all their positions. This is from the Wall Street Journal, I think, this source right here. It's pretty funny because the guy really had no idea what he was doing, and he ended up causing $1 trillion loss in valuation in 36 minutes. It just goes to show you how much of a risk of a market crash we are at due to algorithm pricing. That's why it's important to understand this. Stock market crashes in the past happened, like the 1929 one, I think took a couple months to affect. The 2008 one was, I think, like 2 months or whatever. And then the 2021 was like a month on the 2020 pandemic. So it's very important that all this is because of algorithms auto pricing risk into their formulas. It creates a snowball effect. So why is this important for predicting future market crashes? Well, it's about the time it takes for a market to crash. People will say nowadays that if it doesn't last for a couple months, it's not a market crash. If it doesn't have a recession, it's not a market crash. No, market crashes are just a lot faster now. So fast that I would hypothesize that going forward, we could see much further fluctuations in crashes, like 60-70%, in a matter of like 5-6 minutes, right? Unless the SEC does something to prevent these types of crashes, which there's always laws coming out, but the issue is hedge funds are paid to operate in the gray area that's between illegal and legal, and regulating bodies generally don't care. They just want to make sure it's a somewhat even market for everyone to play in, which is a hotly contested debate. But regardless, algorithms move fast. That's all you need to know. So combining everything to predict the future stock market crash. So here is the thesis of the entire article, the nuts and bolts, everything you need to know and import into your own algorithms or do on your own. We live in an industrial economy whose value is propped up by 3 variables: innovation, credit, and consumption. These variables have to work in cohesion with each other. When one starts to dominate the market, innovation in 1932, credit in 2008, consumption in 2020, then we get a crash. Further, these crashes are happening faster with the advent of computer algorithms. There you go. That's it right there. You need to have all 3 variables working in cohesion with each other. If one starts dominating the others, you'll get a crash. Because if all 3, if innovation, credit, and consumption aren't in check, aren't growing equally, then the other 2 can't keep up with the major one. If the other 2 can't keep up, it's a giant kind of cascading effect where they all fail. There you have it. So looking forward, when you see an imbalance in these variables, for example, it might be start time to think about hedging your position better. I mean, you can for the inverse ETFs, do not hold an inverse ETF for more than one day. Every day you hold it, the capital is less. But if you take a right time at an inverse ETF, like you took it in March of 2020 when the market crashed due to the pandemic, then yeah, I think you would have made like 120% return in a couple weeks or so, 100 a day or something like that, something crazy, from an ETF, which is just unheard of. So this is what hedge funds on the street do. A big one is Dahlia's Bridgewater. Bridgewater Management does this. This is the global way, and it's really the only way to predict stock market crashes. You can look at order imbalancing and like algorithms and have an algorithm auto price, but by the time the algorithm sends you a red flag, the market's already crashed. So that's why you need to import this methodology to start predicting them. So yeah, there you have it. That's the nuts and bolts of predicting stock market crashes. Hopefully, I think you guys enjoyed this. I enjoy writing these, helping everyone else, generate alpha in the market. We run our own portfolios in Chrono Historia, but generally speaking, I'm here just to help you guys, and I'll talk till I'm blue in the face. You can probably tell about this type of stuff. So you can always hit me up on Reddit or Twitter, or even in the YouTube comments. So yeah, here at Chrono Historia, we have a free newsletter. Feel free to sign up if you like all this type of stuff and you want to remain up to date on everything investing. Um, until next time, this is Chills and Day signing off, and I wish you the best of luck in your investment journey.